Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Wednesday. Is today Wednesday? Today's Tuesday. Geez, off to a great start here. Today is Tuesday, September 27th, 5:05 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Got to get my day straight with this hurricane bearing down on the Sunshine State. We're safely tucked on the east coast of Florida, while the west coast is supposed to take the direct hit. We'll see some rising tides and possible local flooding, but should be safe here on the east coast. So let's get into the video. Tonight's Revere Asset Management Market Insight video. State of the market, still in a correction. You can see over here by the trend gauge, we are in bearish / downtrend mode. For market leadership, those rolled over and gave way late last week. And the major indexes, the 5 that we review on every one of these videos, are trending below their short-term 21-day exponential moving average, below the medium-term 50-day moving average, below the long-term 200-day moving average. This is kind of a big flashing red light telling you about the market risk, especially risky under the 200-day moving average. You should have this chart seared in your brains by now. This is why we really get defensive when we get under the 200-day moving average. Normally, when you correct off the top, you're 9 to 12% away from the 200-day moving average. So coming down to the 200-day moving average from all-time highs, losing 12%, really not that big a deal. It's when you get under the 200-day moving average that you have to be concerned. Even just a garden variety bear market down 20%. Our clients haven't seen these since I've been at Revere. In the 7 years I've been at Revere, we get out of the way of these. But even getting back to even from a 20% drawdown requires a 25% gain. Imagine getting caught in one of these heavy highlighted downtrends. On average, 44.5% to the downside. You need 80% to get back to even. That's outrageous to just be able to sit through while your clients are losing money like this. But some advisors do that. Pie chart advisors just because they haven't done the work, they haven't put the work in, they've had a big sip of the Kool-Aid, swallowed it down, thought it tasted good, and they just sit back and they're salesmen. They don't worry about protecting the downside. It's absolutely outrageous. We actually undercut these lows from July today, closed slightly back above them, but we're still in this vicinity, 24.5% off of the highs. When I say we, I mean the market. I don't mean Revere clients. We're down 7.8% on the year. And we'll be compounding from a much higher asset base as if we would have sat this big, just sat and done nothing through this big downtrend. All of Danny's money is in the strategy. All of my money is in the strategy. I don't want to lose what I've worked hard for, and neither should you. And if you're interested in this approach, reach out to me, don@revereasset.com, or email dan@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. We've had several clients that have come over the last couple of months, saw how we treated their account. They brought a partial of their account over, being able to compare it now versus what their other advisor did. The answer is that advisor did nothing, and we're getting the rest of the account now. And we see this time after time after time at Revere, and we're very happy, very gratified to be able to spread the word that you don't have to be a slave to the market to the downside. You can join us and take control of your financial life. Participate in market uptrends. Get the heck out of the way in downtrends. It's what you do in every other aspect of your life. Why should your finances be any different? So, what happened today? I got a little out of order here. First of all, by not knowing what day it even was, but What happened today? Lower lows, but leaders. Growth far outperformed value today, and leaders held up extremely well even while the indexes were pulling back. And we still are -3 ATR from the 21-day exponential moving average. I'll show you what we did with our the long that we took based on the oversold condition being 3 ATR away from the 21. I'll show you what we did with that here in a little bit. So on the day, G6, this is our composite of 6 growth ETFs. Up on the day, I mentioned growth far outperformed. Small cap growth up 0.93% on the day, while small cap value down 0.20. You just can't automatically assume that when you're in a bear market you can hide in value stocks. It just doesn't always work that way. They come and get those also. So the G6 positive on the day, 0.95%. S&P 500 gapped up 1%, ran up 1.5%, rolled over like a dog wanting to get its belly rubbed, made new lows, bounced a little bit in the afternoon, ended up down 0.21%, making new correction lows. NASDAQ 100 barely positive, up 0.04%. Dow down 0.4, mid caps up 1%. Russell small caps up 0.4%. Global diversified 60/40 stock and bond down 0.35%. Amazing run on the 10-year and the 30-year today. The TLT up 2.63%, which means, down 2.63%, which means the yield up strongly. In-house, and I'll talk about how we played that long momentarily, just up 0.09%, had hopes for a bigger gain, but couldn't even get any sort of meaningful bounce despite the gap up. We'll go over the tail of the tape and then some charts of interest here. Let me give a very quick explanation. I talked a little bit, well, actually, I talked a lot about why we protect capital here at Revere, but I just want to explain when we're in and when we're out. I talked about the 3 moving averages. Here's a situation back last October, November when the markets were healthy, and we are participating in this uptrend because our rules get us in. Above the short-term green 21-day moving average, above the medium-term red 50-day moving average, above the black line, the 200-day moving average. We start going sideways, we'll start getting stopped out on a couple of things. Here you have a false breakout. We would get involved in that, but we size our positions so that we never get hurt on any single one position. So when we get stopped out, it's really not a big deal. And as markets start to roll over and the slopes of the line of the moving averages, this is a big flashing yellow light before the red light, which is about to come up. When these roll over, we get pretty concerned. You break below the 200-day moving average. This is when those nasty bear markets can form. Sometimes we bounce back and forth. We'll be in and out trying to solve the puzzle of the market, but eventually we'll get a couple paper cuts in here, but a good trend will take care of them all, whether it's a trend to the downside or the upside, because we know we'll be out of the way, protecting client assets and really gathering a gap between what's happening in the overall market and what's happening in our clients' portfolios. This was a big rollover on a bad CPI report in April. Big leg down, then we bounced, another brief area down. Then we tried to rally, and we participated in this rally and still have some small gains to show for it since we rolled over again. This was the Jackson Hole speech from Jay Powell at the Fed. This was the latest terrible CPI report that showed inflation isn't slowing. And here we are down here making lower lows. Yesterday, I talked about how we took an entry because we were at a -3 ATR from this 21-day exponential moving average on the S&P 500. We've done a lot of studies on this. And when you're -3 or +3, the odds are you're going to revert back to the mean somewhat. And we started doing that at the open today. As you can see, we gapped up here and ran up to 37.17. And then we pulled back, everything normal so far, another move up. And then we started to roll over, and then we locked in our profit in two parts on this for a very small gain. You can see how harsh this move was down from 37.03 to 36.26 in like 45 minutes. Given up almost 2% and then sideways into the close, a little bit of a run, pull back, a little bit of a run. But the fact that we couldn't make any kind of a run when we're 3 ATR extended to the downside from the 21 just emphasizes how weak this market is. I think we will bounce harder at some point, but we're still 6% for the second day now. Actually, the third day, 6% below the 21-day EMA. But for now, any attempt at a rally is being thwarted. So the next signal that I'm looking for, this 8 EMA, is getting very close to the S&P 500 price. If we get above that on a rally, that would be a change in character, because we haven't been above the 8 EMA since this big sell-off day on 9/13, which is when the CPI numbers came out. We may need some sort of a catalyst. We had mixed results from Fed speakers coming out today, one saying that they're worried we might be raising too hard. Three of them say, no, we're not going to make the mistakes of the past. We're not going to stop raising, and then we're not going to cut. So a mixed bag there. But the bottom line is the market is extremely weak. The market is, and the fact that it's below the 200-day moving average just really tells us all we need to know. It's not an opinion that we have. It's just a historical fact that all these bear markets take place below this black line. I know it sounds simple, and people criticize us for trying to use what they consider to be a rudimentary approach like this, but maybe if they did better for their clients, they wouldn't have to criticize us. And the bottom line is the market is extremely risky. It's extremely stretched to the downside, so wouldn't be surprised. As I said, tried to get this yesterday, tried to catch this bounce. We caught a little bit of it, little tiny gain on this. We may try again, but now looking at that 8 EMA, and obviously the tops of the last 3 days coincide to the bottoms over here in June and July. This is what we need to get above. So it's a case of what used to be support is now acting as resistance on any rally up. We might need to go lower before we can slingshot higher. We don't know. We don't predict. We just try to put the odds in our favor and take profits when they're available and minimize losses. We do know that we'll bounce at some point. We do know that the market will start rallying at some point. And we also know that right now we've got a near 1,600 basis points or 16% lead over the S&P 500. We're in a position of strength, and that's really going to show up during the next rally and really going to carry our client accounts much higher from a much higher base of capital, because we didn't give up all of those losses to the market. So let's get to the tail of the tape now and just review things where we are here. The indexes here, I'm showing technically negative. The indexes in the G6, the daily stochastic, all of them are getting buried at this zero area. That this doesn't persist either. This is another reason why you should be looking for a bounce. We're actually going through models of all these 13 bear markets right now, seeing where the behavior is similar to what's going on now, what you can expect under different scenarios. If we're wrong, how we can be wrong small, but if we're right, we can capture a decent move. And we'll put all that knowledge base together to handle the next move up. Put call ratio at 1.15, VIX at 32.78, made a new high recently at 34.14. It's above all the moving averages. This is also something we're going to be looking to for a clue. If this starts coming off of here, this should coincide with a rally up. These numbers did this morning come off a little bit as we rallied, but not enough to stick with it. And really the rally was thwarted this morning as interest rates just continue to climb higher. Fear and greed's at 17. That's in the extreme fear range. Obviously, we're operating under our bear case thesis here since 8/26. I talked about the Fed speakers today. 4 of them came out with different comments. 3 of them hawkish, 1 of them dovish. We went our day count 5 days down and 8 out of 10 days down. We're now on the S&P 6 days down and 9 out of 11. Again, this doesn't persist, but this is the first time that we've seen 6 days down during this entire bear market. So The news continues not to be good. Coming into today, expectations were negative to neutral, negative because of the breakdown on 921, neutral because of how extended we were to the downside, and we got that gap up that we wanted. But as I said, it faded badly. Support did hold both on the S&P, this 3636 undercut, but we closed right at it, right in this range. Same thing with the NASDAQ 100. This bottom support range held, and we're right around this resistance 1 area. You can see what we did today, gap up 1%, another run up to 37.18, then 2 waves all the way down to 36.26, and then just kind of a base into the close. You can see the various ranges that we keep track of. What was strong today? Oils, uranium, and XME. These are just bounces off of recent hard moves down. A little bit of a change in character on the dollar. It started out weak today, ended up just about flat. Same way with the VIX. Bonds really hit hard today. KBE, that's banks, and then XLP, URE, that's staples, utilities, and real estate. As I said, can't just always assume that you can go to the value stocks to support your portfolio. This is another reason why I argue with people that think just collecting a couple of percent dividend puts a big smile on their face when their portfolio is down 20%. Our focus continues to be on shorting bounces into resistance, but as we did yesterday, we will take a small long if we get too extended to the downside. Here's the portfolio. We came in with that 5% UPRO, sold it, took the small profit. Bottom line is the gap up failed. We closed at lower lows, but growth outperformed value today, and we are still, for the third day in a row, 3 ATR. Down from the 21-day exponential moving average. Let's take a look at the resistance or the support areas here. We're at this last support area. I'll be going through and updating this for tomorrow's video, assuming I still have power to do tomorrow's video. If not, Michael's ready to step in. So here's today, gap up fails, close at lower lows. As I said, growth over value, 3 ATR from the 21. Let's take a look at some of the recent leaders that acted today as if we were in a bull market, but this is just today in isolation, not really what's going on overall with the pattern. So let's start with First Solar. This is the one stock that survived the 21 over 21 list from last week, closed below it yesterday, back above it today. This chart still looks fantastic on a relative basis and a price basis, considering what's going on with the indexes. Second strong solar stock that has been a recent leader, Enphase, came down and it's holding around this 50-day moving average here. Really what we're trying to do is identify relative strength and stocks that are setting up on good bases if the market puts in a bottom and starts to trend higher. We're never more than 4 days away from a follow-through day. The likelihood that they succeed this far down is less than they would on a garden variety correction, but we still have a process that we stick to come hell or high water, and that goes for getting involved with the market as well as getting out of the way of the market. So that's what we saw with Enphase. First, let's look real quickly at TBT. This is a reflection of what rates are doing, and you can see just even extending its lead. It's really getting extended to the upside. Let's go to TNX. This is the 10-year. You can see for a while we were just riding the ADMA higher. Now we're escalating higher. It's almost going parabolic. This never ends well. We'll have a harsh pullback on this one day, and that'll coincide with a move up in the markets. Wouldn't be surprised to get several shakeouts before that actually happens. Let's go to 0TYX. This is the 30-year. Same thing, gap up to highs. Really, this one, the longer end of the yield curve is what broke down even harder today, because as you know, when you go to the upside with the price, when you go to the downside with the price, which is what you saw here in TLT, you go to the upside with the yield, which is what we saw in the two previous charts. So what else acted well today? LTHM, and these stocks have fundamentally good stories. good fundamental earnings and or sales growth are just being held back by the market. We've got our list. Some will come out of nowhere that we haven't seen before or been ready for before, but these really haven't led a true upcycle. And that can be somewhat exciting about that we're in the right stocks, because the leaders from the prior upcycle seldom repeat. Maybe, like, I think the odds are about 30% of them will repeat. These are all new stocks. Really, a lot of them tried to break out, but the market has held them back this year. And lithium is one of those stocks, along with those solar stocks. Let's see what else was up more than 3% or more today. CCJ, the uranium stock, as I mentioned, uranium was strong today, bounced at the 200-day moving average. And really what we're doing is keeping track of these, seeing if they're holding at the 50, if they're holding at the 200. If they can't hold the 200, they're really not leaders. And unless they get back above the 200, we won't be considering them. Array, another solar stock, broke down, was one of the first ones to break down. Nice update today, but you can see how this is damaged relative to the charts of Enphase and First Solar. AEHR, this was a big testing company for semi equipment. Hasn't broken down completely. Really, it's just putting in a base, biding its time. It's got the fundamentals, so has a good chance to lead if we get an up leg. Let's look at something that was a former leader but is completely broken down. Here's Net. Had a nice gap up, giving some people hope that it might lead again. But then it faded, and it's under the downtrending 200-day moving average. Look where this thing topped. It's at $50 now. It topped at $221. It doesn't matter what the ticker is. I learned that lesson with PayPal. Despite the ticker, when the chart deteriorates, you got to get out of the way, and that really applies to NVIDIA too, NVDA. You just can't hold these things forever. When they break down hard. This is the second time NVIDIA has had a serious breakdown. This was a high above 340, now trading at 124. Cover up the ticker and go by what the chart is saying. TTD is another one that had a decent earnings report for a while, got above the 200-day moving average, gapped up on big volume. We had some hopes that this could be a leader. It led for about a week before the market rolled over. Again, in August, this was during the July to August rally, but then it rolled over, and now we're trapped below the 200-day moving average again. Wolf had a decent day today. This is not a broken chart yet by any stretch, really putting in a flat base, coming off the lows of this base. This 105 area is providing good support, hasn't touched the 50-day moving average yet, and got back above the 21. BJ's holding up very well. Undercut but reclaimed the 21 today, bounce at the 50-day moving average. So these are the types of stocks that we're keeping on our watch list. Shockwave broke down, still can't get above the 50-day moving average after this big 3-day bout of selling. See if it can get back above the 50-day to at least get back in consideration for possible leadership if the market rights itself. We're not seeing that right now. That's going to wrap it. As always, I'd like to hear from you. You can reach out to me, Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up Tuesday, and it is Tuesday, September 27th. This is Don Vandenbord reminding you it's not how much you make in the markets, it's how much of that you can keep. Thanks for listening, and have a great day.